Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Okay, let's talk about selling your home. It's a huge financial moment, right? But what if I told you there's a way to pocket a massive chunk of that profit, totally tax-free? Yep, today we're diving into one of the best tax breaks out there for homeowners. And it all kicks off with this one giant number. $500,000. Just let that sink in. If you're married, that's how much profit you can potentially shield from the IRS when you sell your main home. And hey, if you're a single filer, it's still a whopping $250,000. Not bad, right? So the big question is, how do you actually get this tax break? What are the rules? What are the myths that everyone seems to believe? Well, to figure it all out, let's start with a situation that, honestly, confuses a lot of people. Okay, first up, the duplex dilemma. What happens when your home is also an investment property? You know, like a duplex where you live in one unit and rent out the other. How does the IRS handle that? All right, let's crunch some numbers with a super simple example. Let's say you bought a duplex for, $300,000. And you got lucky, the market went nuts, and you sold it for $900,000. So that's a cool $600,000 profit. The million-dollar question, or, well, the $600,000 question is, how much of that do you actually have to pay taxes on? And here's where it gets really interesting. You see, the IRS doesn't look at your duplex as just one single building. Nope, they see it as two separate things. You've got your home, and then you've got your investment property. And believe me, they treat those two things very differently. So let's break down the math. It's pretty straightforward, really. We just slice everything right down the middle, 50-50. Your cost basis, that's basically what you paid for it, gets split. The sale price gets split, and that means your $600,000 profit, yep, that gets split too. So the $300,000 gain from the side you lived in, that gets covered by the tax break. Boom, completely tax-free. But that other $300,000 from the rental side, well, that's considered investment income, and you're going to owe capital gains tax on that piece. Okay, so it's clear that living in the property is the key. But for how long? This brings us to probably the most important part of this whole thing, the 2 in 5 rule. And honestly, this is where so many people get tripped up. And this leads to a question I hear all the time. Is the tax break prorated? You know, if you own the house for 5 years but only lived in it for 2, it feels logical that you'd get, 2/5 of the benefit, right? Makes sense. But is that how it actually works? Let's look at a timeline here. Imagine you buy a place. For the first 2 years, you rent it out. Then, for years 3 and 4, you move in and it becomes your main home. And then, for that final 5th year, you decide to rent it out again before you sell. So looking back at the 5 years right before the sale, you lived there for a grand total of 2 years. So does that work? Do you pass the test? And the answer might actually surprise you. It's a big, fat no. The tax code doesn't do fractions on this one. It's not prorated. It's a simple all-or-nothing test. You either meet the rule and get the entire tax break, or you don't, and you get nothing. It's that black and white. So here's the official rule, laid out, plain and simple. In that 5-year window just before you sell, you got to clear 2 hurdles. First, the ownership test. Did you own it for at least 2 years? And second, the use test. Did you actually live in it as your main home for at least 2 years? And here's a little pro tip for you. Those 2 years of owning and 2 years of living don't even have to be the same 2 years. As long as you check both boxes somewhere in that 5-year period, you're good to go. Okay, so getting these rules down is a huge first step. But what if I told you that you could use this incredible tax break not just one time, but again and again? This leads us to what might be the single biggest myth out there about selling your home. The idea that it's a one-shot deal. You know how some financial advice just gets passed down from our parents or grandparents? Well, a lot of it is based on old, outdated rules, and this is a perfect example. So many people believe you only get one chance in your entire life to sell your home tax-free. But I'm here to tell you that is just not true anymore. So here's how it actually works today. You can use this tax break over and over again. The only real catch is that you can only use it once every 2 years. I mean, think about the possibilities. You could sell your home, take that tax-free profit, move into a new place, live there for 2 years to meet the rule, and then you could do the whole thing all over again. It's a repeatable strategy, not a once-in-a-lifetime golden ticket. All right, so we've busted some major myths and we've cleared up some pretty confusing rules. Now, let's just boil it all down. What are the 3 key things you absolutely have to walk away with today? Okay, here are the 3 big takeaways. Number 1, if your property is mixed use, like that duplex example, the tax break only applies to the part you actually lived in. Number 2, that 2 and 5 rule is all or nothing. You pass the test, you get the full $500,000 exemption. It's not prorated. And number 3, and this is huge, this is not a one and done deal. You can use this powerful tool again and again as long as you wait at least 2 years between sales. When you really understand these rules, it completely changes how you look at your property. It stops being just a place to live, it becomes one of the most powerful wealth-building tools you own. So I'll leave you with this question. Is your house just a home, or is it a powerful financial tool that you're using to its full potential?